All right, so good evening once again, guys. This evening we are going to talk about the different types of market analysis. We've already dealt with the basics, okay? All those basic stuff, we already talked about it. So let's look at how we can analyze the market. Last week, while we were talking about some of those basics, and also when we're talking about the candles and the chart itself, a lot of you were asking, some of you were asking questions like, how do we know we are going to buy there? How do we know we are going to sell there and all those things? So, and I answered us that it's when we get analysis, when we are able to learn a way of analyzing the market, that then we'll now be able to have clear understanding of what to buy, what to sell, where to buy, and where to sell them. All right, so here we are now, guys, and I'm going to quickly take you to a blackboard where I can explain these things to us. All right, thank you very much. So let me get my blackboard ready. Okay, so this is a blackboard here, right? And so the first thing we're going to talk about is the different types of analysis. How do we analyze the market? And now there are different ways that traders analyze the market. So you talk to this trader saying, this is how I trade. You talk to another trader, he's saying this is saying a different thing, a completely different. Now maybe there are some similarities, there are some differences in the way people look at the market, people analyze the market. So, but whichever way the market analysis is in two major groups. All right. The first category is what we call technical analysis. All right. And technical analysis. So technical analysis. And then the second one is what we call fundamental analysis. All right. And so what do we mean by technical analysis and what do we mean by fundamental analysis? Now, this one has to do with, using price history, using the price chart history, okay, to forecast and trade what the market will do now or later. Okay, that's just a simple way I could put it. I don't want to use definitions for us. I just want to use something simple and clear that we can deal with. So this one has to do with you studying price chart history, all those candles that we talked about. Okay, each candle represents the price. Now it's all about you studying that historical chart performance. Historical performance of that particular instrument represented or embedded in the chart. And you're now using it to forecast and then using it to trade what the market should do now or what the market could do later. Okay, so that's what we use technical analysis for. Okay, that's what technical analysis is all about, studying the price charts. All right, and we have a lot of studies as regards this. We have a lot of, different ways technical traders approach the market, different technical methodologies, different technical strategies. We're going to talk about some of them and some of the ones I use, all right, so that we can. I'm also going to teach us how we can develop our own strategies as well, so that we can, of course, trade with what fits us the most. So what about fundamental analysis? Fundamental analysis has to do with applying economic, financial, social, geopolitical factors to analyze the market and forecast or trade the next direction, the next or Okay, let's just say the next direction of that instrument. So now this one has to do with applying some tangible stuffs like economic factors, financial factors, social factors, geopolitical factors to analyze the market. So a lot of fundamental traders believe that there are actually things that are moving this market. All right. When things happen, the market moves. So let's look at some example of economic factors. An example is, let's say, the interest rate, the gross domestic product of that country will affect the currency or even the stocks of that country. Inflation, economic recession, all right, they can affect. Financial factors are there as well. Some things like maybe some fiscal policy by the government of that country. Maybe they want to increase tax or they want to cut down tax. Those are financial factors. We also have social factors, all right, like pandemic, like political unrest or any other kind of unrest, or maybe even the bad social ones like war. All right, these things can affect the instrument, can affect the market. All right. We also have, of course, geopolitical factors. Every now and then, you see different countries tussle among themselves. Many of you heard about the United States head of house who went to Taiwan, and then China, antagonizing that. All right, those are geopolitical issues. All right, we've had some geopolitical tensions between United States and China before. We've had tensions between Russia and the United States before. All right, we've had even between the, at the time, like we had even between the European Union and the United States. That sounds strange because they are very, very strong allies. So these geopolitical factors can also affect the market. So what these fundamental traders do is to now analyze these different market factors to decide or to determine the real value or the intrinsic value of the particular instruments. All right. Or they also try to use those factors to weigh in the imbalance between demand and supply. All right, because of course economic is the very basic economic theory says that when the demand is more than supply, what happened to price? What happened to price when the demand is more than the supply? Yeah, the price is going to go up. When the demand is less than supply, price is going to go down. So fundamental traders use this stuff, all right, to analyze and to trade. But technical traders, they don't bother about all this. They believe that all these factors put together can be seen on just one candle. That means a certain candlestick, which is the price. All right, just this candlestick, let's say this is the daily candlestick. So this daily candlestick of that particular instrument shows all the price performance, the price activities of that particular instrument within that day. Okay, considering all these different factors. So they believe that all these things, they have already been absorbed by the price. Okay, they've already been represented by the price. So they don't really need to bother about any of this. So they just focus on the charts and try to see what kind of pattern, all right, the price is exhibiting, so that they can take advantage of such pattern, such situation. So these are the two major ways of looking at the market. Of course, there is it's very possible to use the two of them together, okay, which is what somebody like me do many times. I try to use the two together, use this one to determine the big trend of the markets of that particular instrument, and then I use this technical analysis to decide where I want to get in, all right, and maybe if where I want to get out of that trade. So that's it, guys. Technical analysis and fundamental analysis. And so we're going to look at the two, okay? In these beginners, we're going to look at them fairly enough. We might not really go too deep, but we're going to learn the basic things, the very basic things that we need to understand. And we're also going to learn a technical strategy that we can use to trade at the end. And so in the intermediate class, we're going to go in deeper and learn much more stronger strategy that we can use to trade at the market. Okay, so with that said, I think it's now time for us to look at to start with one of them, whether to start with the technical analysis or fundamental analysis. So we're going to start with the technical analysis, all right? So that's what we're going to start with, all right? So can we go on? If you want us to go on, please type yes. If you have any question, type your question quickly. Let's do it quickly in like 15 seconds, okay? So while I drink water. If you have any question, type it quickly. If you want us to continue, type yes. Okay, while I drink water, so I'll be back in the next 15 seconds so that we can begin, can start looking at technical analysis. Thank you. All right, so let's now look at what we call technical analysis. Let's look at technical analysis. I'm going to look at some fundamentals, some fundamental things that we need to know about technical analysis. So technical analysis quickly. So the first thing we're going to learn here is what we call trend analysis. All right, it's what we call trend analysis. Let's look at trend analysis. Trying to grab that. So trend analysis. Now, before we even look at this, let's come here. So when you look at the price, this is a price chart. This is the 15-minute candlestick. Now, the last class, we looked at each of these candlesticks. Okay, for this chart here, for this particular chart, the bearish candle is red, while the bullish candle is green. All right, and so we can see each of the candle, 15-minute candle. So when you put all of these candles together and you try to zoom out, this is what you're going to see. You're going to see price moving up and down, up and down, up and down, up and down, you know, in different shapes, in different patterns, within, all across the different time frame. So this is what you're going to see. Okay, so this is the price chart on the 15-minute. I can go to the 1 hour. All right, so this is what I have as well. When you go to the 1 hour time, we're also going to see price up, down, down, up, you know, move like that. This is the price chart of gold. It's going to see that it's not that it's going to just move up forever. It's going to move up, down, going to move down, up, down, up. But here you're going to see that the prevailing move was actually the downward. You can see that the sellers were, you know, they overwhelmed the buyers. Okay, they were pushing the price down and down and down. But since 21st of July, the buyers have been fighting back, trying to push price up. And even when the price was going up here, we still saw some downward, slight downward in between that upward move. Just the way we saw slight upward move in between the downward moves that dominated the market between March and July. So that's what you're going to see the market do, almost all of the time, up and down, up. So that's why it's really very important that we talk about the concept of the market trend. Okay, so these are trends. All right, when the price is overwhelmingly downward, it's a downtrend. When it is overwhelmingly upward, it's an uptrend. All right, so let's quickly look at what the market trend is. So that's usually the first way we start the topic trend analysis. So let me just put it this way when I add before I speak. All right, we're going to look at trend analysis. So the first thing we're going to look at is what we call the uptrend. Uptrend, what is an uptrend? Now, uptrend is when the market is going up overwhelmingly, when the buyers are in control of the market. Something like this: up, down, up, down, up, down, up, down, up. Now, the buyers continue to push the market up after some intermittent bearish move that couldn't really overcome the uptrend. So that's what we call an uptrend, when the price is just continuously pushing things up. The buyers are continuously overwhelming the sellers. This is what I would call an uptrend. Okay, and as you can see, price is making new highs. This is the high point. Let's try to identify the high point. This is an high, this is an high, this is an high, and this is an high. And you're going to see some lows. This is a low, this is a low, this is a low, and this is a low. And one thing you're going to discover here is that the highs are getting higher, right? While the lows are also getting higher. So that's what you see in an uptrend. So that means an uptrend is made up of higher highs and what? Higher lows. So that's what you get in an uptrend: higher highs and higher lows, just like we have a higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. That's what you see in an uptrend. All right. So even if let me quickly take you to the chart that we just looked at of recent. So you can see this. You can see price was bearish here. Price down, up, down. Okay, let's look at them small. Okay, so let's look at between here and here. In fact, let me cut. I can actually cut this chart. Let's cut this. Let's cut things, and let's just look at what the price did between here. Between here and here. Now, this is a typical example of a downtrend. It's not an uptrend. Now, let's look at an uptrend. Sorry, this is a typical example of an uptrend, right? It's an uptrend, right? From here, let me say from here, and you're going to see the highs are getting higher, right? So this is the high, this is the high, this is the high, and this is the high, this is the high, and another high. Yeah, so the highs are getting higher. We have a low here, a low, a low, a low, and a low, and also the lows are getting higher. So this is an uptrend, right? When you see the price exhibiting this property, moving in higher highs and higher lows, say that it's in an uptrend. All right, it's in an uptrend. On the other hand, the market sometimes might just be in the opposite direction. So instead of moving up, it might instead be making a bearish trend. So what is now a bearish trend? Or let's say a downward trend, a downtrend, bearish or a down trend. The other one is a bullish or an uptrend. So this is a downtrend or a bearish trend. I hope you can see what I wrote here, right? So what happened there is that you see the price overwhelmingly bearish, making lower lows and lower highs. This is a low. The lows are getting lower. Price is breaking the previous lows and giving us a lower lows, lower low, lower low, lower low. So this low was broken to give a new low. This low was also broken to give a new low. This low was also broken to give a new low, and this one was broken to give a new low. Meanwhile, we're having new highs that are also getting lower as well. Okay, the highs are getting lower and lows are getting lower as well. So this one we have lower low and lower highs. Now that is the property of a bearish trend or a downward trend. All right, so what we are trying to do here is we're just trying to define some terms. Okay, but a bullish trend is when you have price exhibiting the properties of a higher low and a higher high. It's giving us higher highs and higher lows. But for a bearish trend, it's giving us lower lows and lower highs. As we can see on this chart again, on this gold charts, from here, from where we can see clearly that the price is from here, it's been on a bearish trend, right? As you can see, it went down, then went up to give us this low, and then came down to give another low, or a lower low. It went up to give us this high, came down to give us this low, up to give us this high, down to give us this low, right? And now it's giving us another high here. So what we have here is price giving us lower lows and lower highs. Lower lows and lower highs. And so that's it down. This is just a kind of definition, all right? Because even without doing any form of definition, just looking at the chart between here and here, anybody who can see, okay, will know that, okay, this is a downward trend. This is a bearish trend. If I ask from here to here, everybody can see that, yeah, this is a bullish trend, right? So if I ask us from here to here, what is the trend of the market from here to here? Okay, without even looking at the definition, right? Who can tell us quickly if it is uptrend, downtrend, or whatever trend? What do you think the market did from here to here? So quickly drop the response. That's just to tell us that these are things we can even see just by looking at it. What type of trend the market is making. All right. So we all agree that it's upward trend, or uptrend, or bullish trend. So any way you call it. All right. So thank you very much for those responses. So this is a bullish trend. But if we now want to give it some form of definition, you can say that price is making higher highs and higher lows. You can see. Right. So the highs are getting higher and the lows are getting higher as well. So it's just like a step. We are just climbing a staircase like this, right? So just like the highs are getting higher in this case, that's just like a staircase, okay? So that's just what we have here as well. So now, what about the other type of trend? We've talked about the uptrend, and we've talked about the downtrend. So when the market is not trending up, and when the market is not trending down, what can the market do? So if it's not in an uptrend or it's not in a downtrend, the market can be sideways, or we can say in a range. So the price can be sideways or in a range. So when the market is in a sideways or in a range, so that's when it starts making some irregular move. It goes up, comes down, 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 is in a range. Here, we can't clearly say that the price is making higher highs and higher lows. It makes higher high here, it makes lower low here, higher high here, lower low here. It's just not really trending up neither is it trending down. So it's in a sideways move, or we can also say it's in a range. Okay, so when you look at your price chart, the price will either be in a trend or in a range. If it's in a trend, then it will either be an uptrend or a downtrend. Okay, so that's what you're going to see the price do. Okay, most of the time when you check your chart. So having this understanding is the basic foundation of the technical analysis. All right, does it make any sense to us? If it makes sense to you, let me know while we quickly look at some examples of a sideways on our charts. Now look at what the price did between uh, here, what the price did here. Look at what it did there. It went down, up, down, up, down, up, down. Is this an uptrend? This is not an uptrend because it's not giving us a consistent higher high and higher low. All right. And it's not a downtrend as well. It's very clear. It's something we can just see with our eyes, right? That this is not an uptrend. This is not a downtrend. This is a range. All right. So it's not an uptrend, it's not a downtrend. So it's in a range or is in a sideways move. So David says, why can we not say it is stable in a range? Now, stable, I don't really get that question. Why can we not say it is stable in a range? It's just, these are just words, all right? You can use whatever word you want to use it with. But the understanding here is that the market is not trending up, it's not trending down, it's just in a range. It's ranging. Okay, so the language, the word stable now is I don't know, stable doesn't mean it doesn't go anywhere or it's just been okay. You can use the word stable, right? It's been stable, it's not really making any important, it's just going sideways, the range or stable. Some people can say it's an equilibrium. Equilibrium is when the buying volume is meeting the selling volume. Often and often you see the price not just moving up or down, it's just going to go up down within the range, right? All right, but the price will start moving up when the buying volume start exceeding the selling volume. When that we have more buying interest than selling interest, you start seeing price go up, and also price will start going down in a bearish trend when you see the selling interest or the selling pressure exceeding the buying pressure. When the two of them are getting equal, when they're in a kind of equilibrium, you see the price in the sideways range of stability, just like David calls it. So nothing bad when you say that it's stable. There's nothing bad about it. Okay, so we have another range move here, right? See what price did between here is in a range. You can see that choppy. So those are the ways you can see. You're going to see the market most times. Another range move, right? So so those are just the situations, right? So you might actually see price starting an upward move, an uptrend, goes in an uptrend like this, an uptrend, and then it just goes sideways, and then it just continue the uptrend again, then it goes sideways like this, then it start giving us some downtrend, then it goes sideways again, start giving us some uptrend, then it start giving us sideways and goes down. Just like that. We're gonna just see the price in a trend, in sideways, in a trend, bullish trend, in sideways, all right, in a bearish trend, in a sideways, in a bullish trend, a side. So you're going to see that transition between, from a trendy move to a sideways move, almost all of the time when you look at your charts, all right? Or you might even see price moving from one trend to another trend like this. And, just the combinations of those things, uptrend, downtrend, and sideways or range. Okay. So that's the foundation of the price of the chart structure, okay, of whatever instrument you are looking at, whether it's cryptocurrency, whether it's a forex pair, whether it's a commodity, whether it's stocks, whatever. Okay, that's the foundation of technical analysis. All right. So that's it about trend analysis. I hope that makes sense to us. I hope you'll be able to deal with it very well. All right. So the next thing we want to look at now, since we've talked about trade, we also need to look at some other stuff. We're going to look at what we call impulse and correction. We're going to look at what we call impulse and correction. All right. Now, we've already talked about a trend, a bullish trend, a bearish trend. Let's look at a bullish trend, for example, when the price is going a bullish trend. Now, this is a bullish trend, right? We'll all agree that this is a bullish trend. But one thing we're going to notice is that the fact that we say the price is bullish does not mean that at every point, okay, from year to year, the price was always going up. There were some times the price was down, like here, like here, like here, but we still call this a bullish trend. So therefore, it's now better to name each of these waves within the trend. This is a bullish wave. We can call it a bullish move within an upward trend. And this is a bearish wave, a bullish wave, a bearish wave. So these are just names. You can call it other names that you will understand, right? These are just names. I can call it waves for you. I can call it a leg, bullish leg, bearish leg. I call it a bullish move or a bearish move. So, but instead of us to use different names and all of that, it's better we name them. We name the moves in the direction of the trend as impulse. This is an impulse. This is an impulse. This is an impulse. And this is an impulse because they move in the direction of the trend. Okay. So we call them impulse. All right. So when I want to talk next time now, when I'm drawing all this, I will just say impulse. Okay. Just an impulse. So you understand what that means now, right? And then those moves that happen against the trend, they are called corrections, right? Now this is a correction. This one here is correction. This is correction, and this is correction. If the price moves down from here again and then shoots up, this is going to be another correction and then another impulse. So that means a trend is made up of impulses and corrections. Impulses are fast moves that happen in the direction of the trend. They are usually more volatile than the corrections. They are usually quicker, more volatile, and stronger than corrections. Okay, while corrections can be slower, can take more time to form, and a lot of times they are, of course, they are smaller than the impulses. All right. So if I also want to draw a bearish trend, I can say I have an impulse, a correction, an impulse, a correction, an impulse, a correction, an impulse, a correction, an impulse. So all these moves that happen in the direction of this bearish trend, I call them impulses. Why these ones are corrections? Correction, correction. So does that make sense to us? If you understand that perfectly, type 1. Let me know if that you understand that perfectly. So you can see we are trying to build up something here. We're trying to build up something here. If you understand that, it's simple. Just type 1. Okay, so maximum is asking that. So impulse are longer part of the trend. Yes, impulses are the bigger part of the trend. Okay, most times they are actually bigger most times. Okay, but the right definition is they are moves in the direction of the trend. But of course, they are bigger most times. They are definitely bigger most times. So you have impulse correction, impulse correction, impulse correction, impulse correction for a bullish trend, and impulse correction, impulse correction, impulse correction, impulse correction, impulse for a bearish trend. So I've seen a lot of ones. Okay, that's beautiful. So that means that's very simple enough. So let's just be doing that like that gradually. all right? So that I'll be able to build up some. So let's look at this for an example. This is a bullish trend, all right, on the 1 hour time frame of the bull chart from here to here. And then we can easily identify the impulses and the correction. This is the impulse. This is the impulse here. This move is the correction, an impulse, a correction, an impulse, a correction, an impulse, a correction, an impulse. Another person might even look at this as an impulse, as a correction, as an impulse, as a correction, as an impulse. And just like somebody asked that impulses are bigger than the correction, you can see that quite well, right? Most times the impulses are bigger than the correction. So you can see the impulses are also quite fast, all right? They are faster, they are bigger, or they are quicker, they are, more straightforward, like straight. Okay, why corrections are usually slower and more sluggish? Like look at this correction, it even looks sideways. Sideways are, we can also call sideways corrections as well. We can call sideways corrections. So this is a sideways correction. So whether the correction is correction generally are just corrections, whether it's sideways, whether it looks trendy in nature or whatever, it's just a correction. In as much it happens against the direction of the trend. All right. So let's look at the bearish trend. If this is a bearish trend, this is an impulse correction, impulse correction, impulse correction, impulse correction, impulse correction, impulse. And then what happens? Price quickly change direction. And then what do we start having? Another, we start having bullish trend. Price quickly transited into the bullish trend. Having, impulse correction, impulse correction, impulse correction, just like that. So that's how trends are made up, whether it's an uptrend or a downtrend. So they are made up of impulses and correction. So now let's now try to look at impulses and correction better. Maybe we can define impulse and correction better. Now, or let's just look at the corrections. We know what impulses is. Now know what corrections are, what impulses are, what corrections are. Now, what you're going to notice is that the corrections, they of course are smaller than impulses. I say most of the time, but actually it's actually all of the time. This is an impulse, this is a correction. Now, the correction is formed within the body of the impulse. A correction should not be bigger than the impulse. Okay, so that's why when we have an impulse, this is the starting point of the impulse. All right? And this is the ending part of this impulse. Now, the correction is going to start from the ending part of the impulse. So the correction is going to start from here. All right, now this is going to be a correction provided it does not go bigger than the impulse, provided that it doesn't touch here, but it doesn't break below here. Because if it breaks below there, it becomes bigger than the impulse. Then we can no longer count it as a correction of this impulse. So corrections are measured relative to the impulse that is formed immediately before them. Okay, so a correction is measured with respect to the immediate impulse that was formed before it. Okay, just like if I do impulse correction, impulse correction, impulse. Now this correction is the correction of this impulse. This correction is the correction of this impulse. Now if I have another correction here, it's going to be the correction of this impulse. So if it is now going to be a correction of this impulse, it means that it should not break below here. Once it breaks below here, it's no longer an impulse. It's no longer a correction of this impulse. That's what it means. That means no longer a correction of this impulse. So the corrections must stay within the body of the impulse as the price, glides upwards to continue the trend. So if you see another impulse here and another correction begins, this correction also must not break below here. All right, it shouldn't break below here. So that is why when the price is moving up, it's giving us higher highs. That's why it's giving us higher highs, okay? Because the starting point of each impulse is not being broken by the price. Just like we have this higher high, higher high, higher low, higher high, higher low, and here. The reason we're able to have that is because price is not breaking below. It's not breaking below the starting point impulse. Not break. This one didn't break below here. This one didn't break below here. This one didn't break below here. That's why the highs, the lows are getting higher, and also the highs are getting higher. So that's why we're able to maintain the bullish trend. Okay. So if you understand that perfectly, let me know. If you understand that perfectly, please type 1. If you understand what I just said perfectly, type 1. So I have a question from Maxim, says, so corrections are moves against the direction of the trend. Perfect. Maximum, that's a perfect answer. Corrections are moves that happen against the direction of the trend. Okay. So we've been able to so far establish that when the price is trending, it's giving us higher high and higher lows in uptrend and lower lows and lower highs in a downtrend. We're also able to establish that in a trend, the moves, those fast moves that happen in the direction of the trend are called impulses, while those ones that happen against the direction of the trend are called corrections. And we also established that a correction is fixed with the previous impulse. Okay, that correction is the correction because it is not bigger than the previous impulse. Once it's bigger than the previous impulse, then it's no longer the correction of that impulse. All right. And once it doesn't break below here and it goes up to break above here again, goes up to break above here again, to show that the trend continues to build up and build up and build up and build up. So let's quickly do more wrap-ups. So let's look at the typical trend like this. So price is starting the trend, it gives us this low and makes a correction. So we have the first impulse and the first correction. Now, if this trend is going to continue, what should happen? Price should break below here. All right. So that's the minimum thing we want to see. So this is the high, the previous high. This is the low, and we are getting a new high now. All right. So what should happen next now is that price should break below here. Once price breaks below here, all right, it shows that the trend continues because we now have an impulse and a correction and an impulse. So with that now, we now have another high here. So we have two highs and we have a new low forming. Now, when the price now makes another correction of this impulse, we don't want that impulse to break above, right? So in as much the impulse has not broken above, we can still say that the trend is still strong and it can still continue. All right. So that means then that this is the new low here and we are getting another high. So in as much that high, this new move does not break above the most recent high, it shows that the trend is still bearish. So we're going to confirm the continuation of the bearish trend if price now breaks below this here. Once price breaks below here, we can say that yeah, we have a new high here and an impulse, another impulse there. So that's the way price is going to be moving. If it makes another move here, another correction, maybe this one is deep, deeper than what we've seen so far. In as much it doesn't break above here, the trend is still really strong. This is just a correction. And so this is now the new low. Okay, why this one is the most recent high. So a new high is going to form when price breaks the most recent low. So when price breaks below this one again, the bearish trend also continues. And so we have a new high here and a new low is forming. So once price starts moving up again and give us another correction like this, what happens? We have we can see that the trend is still ongoing. So if price now, okay, we have a new low here, right? So for the trend to continue, we have to see a break below here. So once price breaks below here, we have a new high, which means that when price starts the new correction, it shouldn't break above it for us to say that, okay, the trend is still very much intact. So this is now going to be the new, and then we'll have to see the price break below this new again. And if it does, then we can say that the trend continues. Now, this is a typical strong bearish trend, which a typically strong bearish trend, which means that the lows are going to be broken, okay, to give us new highs that are not touched. Okay, new highs that are not touched. All right. So the same thing happens when the price is trending up. You have price breaking the highs, making correction, break this high to continue the trend, make correction, break this high to continue the trend, make correction, break this high to continue the trend. All right, while we have the lows untouched, you can see price didn't touch the lows, didn't touch here, didn't touch here. Okay, while it's breaking above the previous high here. Now, that is a typical bullish trend. It shows that the bullish trend is really, really strong. Now, when are we now going to have when are we now going to start noticing that the trend is getting, at what point are we going to start noticing that the trend is getting weak? It's very simple. Now we say that in a bearish trend, the highs, the previous highs, must be respected. Okay. Okay, it means that the trend has to be. I'm going to answer the question very soon. Okay, so when the price is in a bearish trend, for example, in as much the price does not break the most recent high, it shows that the trend is still very strong. But now for this one, now this is the most recent high. The moment we see the price, break above the most recent high, now there's a change of structure here. Okay, there's a change of structure, which now means that we're starting to see a weakness of this trend. So that means a bigger correction is now coming. Now, this one's a correction of the impulses. Why this one is the correction of the trend? Okay, are we getting it? This one is the start of the correction of the old trend from here down to this place. While we have the correction of the impulses, we can also have the correction of the trend. The correction of the trend starts when we have a break of structure or a change of structure. A change of structure happens in a bearish trend if the price breaks above the most recent high, which is this one. So we can now say that now a bigger correction starts. That's the correction of the trend. It starts. All right. The same thing here. Price is breaking the highs and breaking the highs, but the lows are not touched, which means that the bullish trend is still strong. When do we now start noticing the correction of the trend as a whole? Or when do we start noticing the weakness of this trend, a real weakness, not just the correction of the impulse, not just this, the correction of the impulse are minor corrections. When are we going to see a major correction, which is the correction of the trend itself? It's going to happen when we see a break of this low here, the most recent. Once the price breaks this most recent, we can say that it's a change of market structure, all right, which means that a bigger correction is coming, all right, which means that the old trend is getting even much weaker now. That means there's a chance that the sellers gain much bigger control. Okay, so that is how the market moves, ladies and gentlemen. That's how the market structure itself. That's why the market builds up all these moves, bullish moves, bearish moves, and then makes corrections and all that. Okay. Now, when the price now begins the correction of this one, the correction can continue downwards like this, but we don't want to see it break below here. All right. Because once you see it breaks below here, what does it mean? It means that there is a complete change of trend between the bullish trend and the bearish trend. All right. So when price breaks below here, it's still a correction. It's just like what we have for these impulses and corrections. So these impulses and corrections, they are just the smaller version of the end of the trend and its own correction. You get it now? So these ones are just like the smaller version of the trend itself. So the trend itself is an impulse also, so to speak. Okay. So when it starts its own correction, it must also not break below here. Otherwise, it's not going to be a correction, because if it's a correction, then after making all those corrections, the next thing is you want to see price break above this top to continue what the bullish trend again. And then so that's how the price just continue to build up and build up and build up, and then make up trends, change from one trend to the other. So this is how traders now look for trading positions here and there, by understanding the structure of the market, the way it moves. Okay, I hope it makes sense to us. Does it make sense to us? Do we need to, should we, let me know if it makes sense to you before we look at some examples. So what we have just done now is to look at, we've just look at impulses and corrections, all right, the way they work with the trend. So please let me know what you think. Does it make sense to you, or is that something else you want to, something you want to understand better, or should we move further to see some examples? Let me know, please. Okay, I'm here to get I'm here to get any response. Is it getting difficult now? Let me know if it's getting difficult. Okay, so that maybe we'll look for another way to explain it. Okay, so I have something from David says, does it mean that trend changes when correction is bigger than its impulse? Yes, we can say that. Once you see a correction bigger than the impulse, then there is a weakness happening. All right. So once we see this move here, this is supposed to be the correction of this, but it's getting bigger and it breaks the most recent high of the bearish trend. It means there is a change of market structure, just the way we have it here. Okay, so let's look at it again quickly. So what we just said was that when you have a trend like this, a trend is made up of this impulses and corrections. All right. So this is a bullish trend. Now, a change of structure or a break of structure is going to happen. Okay, when the price breaks below the most recent peak. That break of structure means a bigger correction is happening. Remember that when the price is going up, we said that the most recent highs are not touched. They are not broken. When the correction, when price is going up like this, makes this correction, breaks up. When it started to make the next correction, it won't touch here before it push up. When the next correction is starting, it won't touch here also before it pushes up. But there's going to come a time when that correction now breaks here, the most recent low here. This is a bullish trend. It is at this point that we say that the old trend itself is starting a correction. It's getting weak now. It's no longer a minor correction of the impulses. It's now a major correction. That's like the correction of the trend itself. That's what we're saying. Okay. Okay, so these are something we're going to, of course, learn gradually when we watch again, we practice this thing, and we're going to understand much better. Okay, that's just what we're saying. The same case when the price is going down, when you are in the bearish trend. Now, this is a bearish trend. At every time the price is making those bullish correction, it doesn't touch the previous highs. Yeah, this is the correction of this impulse. This is the correction of this impulse. Now, when these corrections are up, they don't doesn't touch the starting point or the ending point of the previous correction. All right. But there are going to come a time when it's going to break above it. At that point, what we say here is that there is a bigger correction. That means there's a major correction. That's like the correction of the trend of the old trend itself. Now, these ones are minor corrections of the impulses. Impulses are the trendy moves within the direction of the bigger trend. All right, impulse correction, impulse correction, impulse correction, impulse correction, impulse correction. So these are minor corrections. Impulses, correction of the impulses are minor correction. Now the bigger correction is going to happen when the price breaks above this top here. So that's when we say, yeah, the bigger correction is starting, which is like the correction of the trend itself. Just the same thing you have here when the price is going down. It's breaking here, okay, and is respecting this previous highs. But the moment it breaks above it, say that a bigger correction is starting. Okay, it's still the same. Say the bearish correction is starting, all right, like this what we're seeing, and price is not touching the previous low. The moment it breaks below it, we say that there a bigger correction that is starting. That's like the correction of the trend. Okay, so that means a weakness is starting. Don't worry, we're going to talk about the meaning of those weaknesses, what we're going to do with them. Okay, we're still trying to put in some foundation, put in some kind of definitions that we can build on later. That's what we're trying to do. So at least you guys know what impulses and corrections are, right? And you know that they make up the trend. And then you know when the bigger correction is starting, which is the breakout, when the price breaks the bearish structure. Now the bearish structure is not broken when it's making lower lows and lower highs. But the moment it breaks the previous high, the bearish structure is broken. That means there's a weakness coming. There's a bigger bearish correction coming, bullish correction rather coming. The same way when the price is ascending like this, making higher highs and higher lows. The lows are being respected. They're not being touched. They're not being broken. The moment the price breaks it, what happens then? There's a break of market structure, which means the bullish trend, the structure of the bullish trend has been tested, has been broken. Okay, so that's just what we are trying to say. Okay, so let's look at some examples. Okay, let's look at some examples. Let me look at a market that trends very well. So let's look at let's try to cut here. Now, when you look at this chart from here, you can clearly say that the price was what? Bullish. Impulse correction, price breaks above here, gives us another impulse, makes another correction here. We can see that this correction didn't touch here, right? Price breaks above here again, makes another correction. Okay, when price breaks above here, what happened? Gives us another. What happened here? This was the first time price touched this low here. This is a sign of weakness of this bullish trend. That's what we're saying. So that means a bigger correction has now started. All right. A bigger correction has not started. And until the price breaks above here, we are in a bearish correction. Okay, don't worry, you're gonna get all of these things later. We're gonna explain more of this later. No, it's not really something we can completely understand now as beginners. Okay. So that's why we please need to attend all our classes. So can sell price broke above to reestablish the bullish trend. So when the bullish trend is reestablished, so that means you now start counting the bullish trend again. So you can see upward, downward price breaks above here, and then continues to go up like this. Let me close. All right. So after price broke above, you can see the way it continued to move. Higher highs, breaking all those highs, never came to the lows. This is the only time it came to the low again. Okay, even here, break here, this is a low, this is a low, price broke below this one, we had this correction, and then price broke above this high again, and the bullish trend again, you know, just so on and so forth. We're going to give us more explanation, but if you can take something from what we just talked about this evening, what you should take from here is what a trend is, what a correction is, what an impulse is, and what a breakup structure is. Okay, or let's say a change of structure, what it is. Okay, so if you understand what trend is, type 1. If you understand what the trend is, you understand it perfectly. Type 1. Let me just get one from, let's say, 3 people. If you understand what trend, don't worry, don't be overwhelmed. Don't be overwhelmed at all. If you understand what the trend is, the way we explained it, let me know. Okay, we have okay, we have all those ones. Okay, that's it. Now let's move to correction. So let's move to corrections. Okay, so if you understand what correction is, type 2. If you understand what corrections are, correction and impulse and correction, if you understand what they are, type 2. Let's take them together. If you understand what corrections and impulses are, type 2, 2, 2, 2, 2, 2. Okay, so job is done. Okay, maybe I'm just moving us too fast. Okay, so we've achieved something. Now, what about the change of structure? If you understand what the change of structure is, type 3. If you understand what the change of structure is, type 3. If you understand what a change of structure, type 3. If you don't understand change of structure, type 4. Okay. If you understand change of structure, type 3. If you don't understand change of structure, type 4. So I believe all of us know what trend, correction, and impulse. So we have David says 4, Emmanuel says 4. Okay. So that's the only thing we need to understand now. And I've already explained that, but let me just tell us again. Now, this is a change of structure. What we're trying to say is that when the price is trending, it's going higher highs, higher lows, higher highs. And in a bullish trend, price does not touch the previous lows. That's what we're trying to say. Price does not touch the previous lows. Or maybe I should just build it. Let's say you have a bullish trend, an impulse, and a correction. And then you have another impulse. When the price makes another impulse, you have this low here. Now, when the price is making this correction, what we are saying is that when the price is making this correction, a new correction of this impulse, it shouldn't touch here. If it touches here, that's a change of structure. From what? From bullish to bearish. That's what I'm just trying to say. But instead of it to change its structure, it now continues to go high and breaks above this high. It means that what? The bullish trend continues. So when it continues, that means we have a higher high here, a higher low rather, which now means that if the next correction is starting, if you have the next correction shouldn't touch here as well. If it touches it, then we have a change of market structure. But if it doesn't and breaks up to give us another higher high, so that means this is now going to be the new what? The new low. Now let's say now this time around, price now comes and break here. That's what we call a change of market structure. From what? From a bullish to bearish. Let me give us an example of a bullish, of a bearish trend. That one is a bullish trend. Price started this bearish impulse, and then we now have this bullish correction. Let me use red. Okay, bullish correction follow. So which means this bullish correction should not touch here. That's going to be a change of structure. Because in a bearish trend, the highs are really, really very important to the structure. While in a bullish trend, the lows are important to the structure. They must not be broken, or else we have a change of structure. But here, the lows are going to be broken. All right. So if the price breaks this with this impulse move, so that means then we now have the most recent high move from here to here, which then means that when price now starts a new correction, it shouldn't break above here. If it breaks above here, that's a change of structure. But if instead it now breaks below this here, that means the bearish trend continues. In a bearish trend, the lows are expected to be broken, but the highs are expected to be expected. While in a bullish trend, the highs are expected to be broken, while the lows are expected to be expected. So when these lows are disrespected, that's a change of structure. When the highs here are disrespected, that's a change of structure. All right. So if another correction now starts here, if another correction starts here, it shouldn't break above here. Breaks above it, that's what we call a change of structure. But if it goes down and breaks below here, so that means the bearish trend continues. And this now means this new high here. The price makes another correction of this impulse, but doesn't break here, instead breaks below here. The trend continues. So there's no change of structure there. So you have the most recent high jump down to this place. So if let's say, because at some point there's going to be a change of structure. Once price now breaks below this high, you have what we call a change of structure. All right, that's what we have there. So I believe with that explanation, now we all now know what a change of structure is. Let's not even talk about weakness. Let's just call it change of structure. Do you really understand what it is now? If you understand what it is, type yes. If you don't, if you understand, type Y. If you don't, type N. Let's get it again. If you understand it, type Y. If you don't, type N. Okay, I'm getting so many Y's. I've not gotten any no yet, so that means we're understood. Okay, that's good. We are doing a good job so far. Do you agree with me? So that means we're all doing well. As I'm explaining, you guys are coming down to get this concept very well. So I think many of you will become very good traders. I think that actually. So so that's it, guys, about that. I don't think we should build on that today. We should continue from the next Wednesday to build on this. so will not collapse everything that we have learned so far. Okay, we are getting more technical now. And what you are learning, yes, it's supposed to be beginners, but we are looking at the beginners class in an advanced way. That's what we are trying to do. So that when we get to the intermediate level, I'm going to explain all of these things again, but because you've heard about them again before, I will just talk about them briefly and then you understand and then build whatever structure to build on, right? So let's just end here today. Thank you very much for attending the class. Now, before I go, let me ask your questions. So do you have any questions generally from what we have talked about? Or do you think maybe we should look at some price charts and okay, let's not look, let's just go. If you have any question, please type your questions quickly. If you want to say something, please let me know. Type that you want to say something. Okay, just raise your hand. Let me see all this. Or just raise your hands. Raise your hand so that I can. Okay, I think a hand has been raised. Okay, maybe it's not raised. That's wrong. Emmanuel. Emmanuel, do you still want to speak? Okay. Femi says, welcome, Mr. Okay, thank you very much, Femi. Appreciate that. All right. So any questions, anything we all want to add? You might want to add something, want to ask a question, you might want to anything, please feel free. So let me stop the recording here. Thank you very much.